and a very good day to our lecturer, Madam FARIHAH, and my fellow classmates. We are from Group 4 of our members for presenting the Academic Industry Berhad. I am Nur EZATY SHA'ARI and my student ID is 2022908001. As for starting our presentation, I will start with the background of the company. In 1963, the Academic Industry Berhad, also known as DLMIB, was established in Petaling Jaya, Selangor. DLMIB is a 600-person company that provides a wide range of tasty and high-quality milk-based dairy products, including fresh milk, yogurt drinks, and powdered milk. The business is a division of Royal Friesland Campina, a Dutch dairy cooperative that is among the biggest in the world. Jakim and Jais enforcement officers regularly conduct through-site inspection of our production facilities because we are manufacturer of halal dairy products. Thank you for the previous presenter. Let us move on to the financial ratios of DLMIB for the past 2 years, which in 2022 and 2021. The purpose of financial ratios is to offer entrepreneurs a way to evaluate their performance and compare it at the similar business in their industry. There are 5 financial ratios to be present, which are the liquidity ratio, activity or efficiency ratio, leverage ratio, profitability ratio, and market ratio. For liquidity ratio, it can be divided into 3 categories, which are current ratio, quick ratio, and cash ratio. As shown on the slide, current ratio is a financial metric that assesses a company's short-term liquidity and ability to meet its immediate obligation. It is calculated by dividing the total current asset by the total current liability. In 2022, DLMIB has 1.12 times in current asset for every RM1 in current liabilities, while in 2021, DLMIB has 1.58 times in current asset for every RM1 in current liabilities. This shows that the higher current ratio indicates a greater capacity to cover short-term liabilities, which suggesting a more robust financial position. Next, in quick ratio is where a financial indicator that assesses how well a business can use its most liquid asset to pay down its short-term debt. It is computed by deducting the current liabilities from the total of current asset and total of inventory. In 2022, DLMIB has 0.59 times in quick asset for every RM1 in current debt, while in 2021, DLMIB has 1.05 times in quick asset for every RM1 in current debt. In short, a higher quick ratio suggests a better ability to meet short-term obligation without relying on selling inventory, providing insight into a company's liquidity and financial health. The ratio in liquidity ratio is cash ratio, where a metric used in finance to evaluate a business can use its available cash and cash equivalent to pay its short-term obligation. The computation involves dividing the aggregate amount of cash by the current liabilities. In 2022, DLMIB takes 0.24 times to cover all current liabilities immediately without having to sell or liquidate other assets, while in 2021, DLMIB has 0.39 times to cover all current liabilities immediately without having to sell or liquidate other assets. To the next ratio, which is the activity or efficiency ratio, where it can be divided by 5 categories, which are inventory turnover, average collection period, total asset turnover, receivable turnover, and fixed asset turnover. For the first part of efficiency ratio is inventory turnover. By generating the sales of its inventory, DLMIB used 4.29 times and 4.56 in year of 2022 and 2021 respectively. Next, for average collection period, the calculation involves dividing the total account receivable by the average daily sales. For example, DLMIB takes 27 days in 2022 and 25 days in 2021 to collect its account receivable from the creditor. A shorter average collection period suggests that a company is more effective in collecting payment, promptly improving its cash flow and overall financial health. Total asset turnover is the next ratio need to be discussed with. It is calculated by dividing a company's total sales or revenue by its average total asset over a specific period. This ratio provides insight into how well a company utilizes its asset to generate sales. For instance, LMIB has 1.59 times in 2022 while 1.62 times in 2021. Next, the receivable turnover. It is calculated by dividing the net credit sales by the average accounts receivable during a specific period. As in 2022, the LMIB has 13.71 times of efficient in collects its receivable, while in 2021, the LMIB has 14.85 times of efficient in collects its receivable. As the last part in efficiency ratio is fixed asset turnover. It is calculated by dividing a company's net sales by its average fixed asset during a specific period. For example, in 2022, the LMIB takes 3.72 and 5.17 in 2021 times of utilization of its plant and equipment. on to the third financial ratio, which is the leverage ratio. Basically, this ratio can be divided by three parts, which are the debt ratio, debt to equity ratio, and time interest earned ratio. For the first part of debt ratio is where it is a financial metric that assesses the proportion of companies' total asset that are financed by debt. It is calculated by dividing a company's total debt by its total asset. In 2022, the LMIB used 52.98%, 44% in 2021 of total funds by creditor as compared to funds provided by the owner. It is a key indicator for investors and creditors assessing a company's financial health and risk profile. Next, debt to equity ratio is computed by dividing the total debt by equity held by shareholders. This ratio sheds light on how much a company funding is provided by the debt as opposed to equity. For example, the LMIB used in 2022 of 1.13 and 0.83 in 2021 times to finance a firm's asset. A high debt to equity ratio indicates higher financial leverage, suggesting a greater reliance on borrowed funds for operation and potential higher financial risk. Last but not least, the time interest earned ratio, a financial metric that assesses a company's ability to meet its interest obligation on outstanding debt. It is calculated by dividing a company's earning before interest and taxes, its interest expenses. For instance, in 2022, the LMIB has 16.02% to measure the ability to meet interest payment, while in 2021, the LMIB has 99.72% to measure the ability to meet interest payment. With that, I will pass to the next presenter to continue explaining the next two parts of financial ratios.
Thank you for the previous presenter. Let's move on to the profitability ratios of the LMIB for the past 2 years, which is in 2022 and 2021. The purpose of profitability ratios are financial metrics that assess a company's ability to generate profit relative to its revenue, assets, equity, or other financial metrics. There are 5 financial ratios to be present, which are the gross profit margin, operating profit margin, net profit margin, return on asset, and return on equity. For gross profit margin, as shown on the slide, gross profit margin is a ratio that assesses the percentage of revenue that exceeds the cost of goods sold. It is calculated by dividing the gross profits by the total sales times with 100. In 2022, the LMIB has 26.54% in control cost of goods sold to its revenue, while in 2021, the LMIB has 35.25% in control cost of goods sold to its revenue. This shows that the higher gross profit margin, that relative contribution margin from sale. Next, in operating profit margin is where profitability ratio that measure the efficiency of a company's core operations in generating profit. It is computed by dividing the operating profits from the total sales time with 100. In 2022, the LMIB has 50.40% in productivity of assets in return to both creditors and stockholders, while in 2021, the LMIB has a negative 1.31%. In short, a higher operating profit margin suggests a better ability to produce asset in return to both creditor and stockholders. What is net profit margin? Net profit margin is where a metric used in finance to provide a comprehensive view of the company's overall profitability. The calculation in net profit margin is dividing the aggregate amount of net income by the sales times with 100. In 2022, the LMIB takes 3.45% net profit margin, while in 2021, the LMIB takes 21.87% net profit margin. Indeed, a higher net profit margin is generally considered favorable as it reflects the company's ability to control all aspects of its operation and generate profit efficient. Next, for return on asset, the calculation involves dividing the net income by the total assets times with 100. The LMIB in 2022 have 5.47% return in assets and 35.37% in 2021 overall return of its assets investment. A higher return on assets is generally considered as it suggests that the company is effective and utilize its assets to produce earnings. Moreover, in return on equity, it is calculated by dividing net income by shareholders' equity times with 100. For instance, the LMIB has 11.65% in 2022, while 64.82% in rate of return on the investment of the common stockholders. A higher return on equity is generally considered as it suggests a higher return on the equity invested by the shareholders. Let's move to the last financial ratio, which is the market ratio. For this ratio, can be divided by 5 parts, which are the earnings per share, dividend per share, dividend payout ratio, price per earning PE, and dividends yield. Next, earning per share. It's computed by dividing net income available to common stock by number of ordinary issue share. For example, the LMIB have RM 0.72 for every RM 1 ringgit of shares in 2022 and RM 5.39 ringgit for every RM 1 ringgit of share in 2021. A higher EPS, earning per share, is generally considered as a favorable to because it indicates more significant earnings per share for investor. Next is the dividend per share. It is calculated by dividing ordinary dividends by number of ordinary share issue. For instance, in 2022, the LMIB has RM 0.50 ringgit for every RM 1 ringgit of share invested by the shareholders, while in 2021, the LMIB also has RM 0.50 for every RM 1 ringgit of share invested by the shareholder. With that, the resulting of dividend per share figure indicates that the cash dividend that each shareholder will receive for each share they own. Furthermore is dividend payout ratio. It's computed by dividing dividend per share by earning per share. For instance, the LMIB have 69.44% of net profit to shareholders as dividends in 2022 and 9.28% in 2021. A higher dividend payout ratio means a large portion of earnings is being returned to shareholders, while a lower ratio suggests the company is retain more earnings for other purpose. Next is price per earning ratio, what we call is PE. It is calculated by dividing market price per share by earning per share. For instance, the LMIB has RM 100.42 ringgit in 2022, while RM 71.89 ringgit for investor willing to pay in 2021. The PE ratio is an essential tool for investor seeking to make informed decision about the valuation of a company stock. The resulting of PE ratio provides insight into how much investors are willing to pay for each dollar of earnings. Last but not least, the dividend yield is calculated by the latest annual dividends by market price per share. In 2022, the LMIB has 35% of the market price to shareholders as dividend, while in 2021, the LMIB produced 6% of the market price to the shareholders as a dividend. With that, the resulting percentage represent the yield an investor will receive if they held the stock for 1 year and received dividends based on the current market price.
We move to the next part, which is identifying, analyzing, and justifying the ratio of the company. The first is liquidity ratio. Liquidity ratio can be referred as a set of financial ratios that give an overview of a company's ability to satisfy its financial commitments immediately or within a shorter period of time. Liquidity ratio also indicates the company's ability to pay liability and return financial commitments within a short period of time, such as 1 year. As a result, a higher value of this ratio is preferable since it shows the firm's capacity to satisfy its short-term commitments more readily and efficiently. In liquidity ratio, it has current ratio, quick ratio, and cash ratio. So we move to the first part of liquidity ratio, which is current ratio. This ratio measures general liquidity by taking into account the company's current assets and liabilities. In this ratio, the Dutch company's current ratio in 2022 is slightly lower than in 2021, with 1.12 times and 1.58 times current assets for every RM 1 ringgit in current liabilities respectively. As a result, it shows that there is not too much difference or improvement in the liquid position of the company for the period of 2 years according to its current ratio. This ratio is expressed as a 1 ratio, which means that for every RM 1 ringgit of current liabilities, the lady has RM 1.5 of current asset in 2022 and 1.58 ringgit of current asset in 2021. A low ratio is thought to indicate that the company will be unable to service its short-term debt enough. For the quick ratio, this ratio differs from the current ratio in that it does not take into account inventory. Stocks are excluded from current asset in quick ratios since they might take time to sell and convert into cash, although stocks are included in current ratios. Logically, this is due to the ease with which inventory may be transformed into cash. For every RM 1 ringgit of liability, Dutch lady has up to RM 1.05 in 2021 and RM 0.59 in 2022. Again, the result in 2022 shows a slightly decrease compared to the prior year. As a result, this low ratio implies that the company will have difficulty meeting its short-term debt commitments. To enhance the quick ratio, the firm must take initiatives such as decreasing stocks to raise immediate liquidity, shortening customers' credit periods to increase cash receipts, and focusing on current assets that may convert to cash without the use of stocks, among other things. The last part in liquidity ratio is cash ratio. This ratio is also used to assess the company's liquidity since it compares the amount of cash and cash equivalents to its current liabilities. It specifies the company's capacity to meet short-term obligations using available cash and or the other new financial resources. Based on the calculation made, Dutch lady will have 0.24 times cash to satisfy its liabilities without having to liquidate other assets in 2022, up from 0.39 in 2021. This also indicates a decrease in the firm's liquidity situation. To improve this cash ratio, the company needs to focus on reducing current debt and increasing the amount of cash and cash equivalents. So looking at the whole, the company recorded a low value showing poor performance on its quick ratio and current ratio and cash ratio, ranking in both years, with 2021 being slightly better. To improve the annual ranking, Dutch lady should further increase their effort to improve this ratio. Next, the leverage ratio refers to a set of financial ratios that assess on how much debt the firm utilizes in its capital structure. In general, the larger this percentage, the riskier the borrower's exposure to the company, making credit more difficult to get. A lower leverage ratio is more acceptable and beneficial for the firm since it demonstrates better debt management and can boost creditor trust in the organization. Under the leverage ratio, the first to calculate is debt ratio. This ratio can determine a company's overall amount of leverage. A greater ratio indicates that the business has more liabilities than assets. Dash lady debt ratio is 45.44% in 2021. However, the percentage of total funds given by creditors increased slightly to 52.98% when compared to funds provided by the owners in 2022. This ratio reflects an intermediate value, with the firms relying on 45.44% to 52.98% of its debt as finance and 54.56 to 44.02% of its capital. To improve the debt ratio, organizations must take action to limit the usage of debt in their capital structure. This includes paying off part of the current debt, reducing new loans, and etc. Next, debt to equity ratio. This is a proportional part of the equity used to finance a company's assets. Furthermore, it assesses a company's ability to finance its operation using debt versus equity funds. According to the calculations, Dash lady utilized up to 0.83 times to the equity to debt ratio to finance its asset in 2021. However, the ratio is growing in 2022, reaching 1.13 times. As a result, it appears that the company will rely on debt rather than stock in 2022. When the company's debt level rises too high, it will be exposed to higher risk. So, to reduce risk, companies need to take measures that reduce the use of debt in the capital structure. Furthermore, for time interest earned ratio, this is the proportion of time interest received, which evaluates the company's ability to satisfy its interest payment. It may also be estimated using the firm's present level of profitability, which indicates how many times the company can pay its required interest cost. In 2021, the firm Dash has a ratio of 99.72% to measure its capacity to fulfill interest payments, which reveals the interest payments they must make using their income before interest taxes. However, the ratio will fall even more in 2022 to 16.02%. A lower ratio is undesirable since it shows that the company is at risk of insolvency. Therefore, to improve the time interest earned, companies can increase net profit through cost reduction strategies or income increases. So, through the results, it can be seen that Dash lady has a weak and poor position in its leverage ratio when it has a high amount of debt in its operations. Next, we move to another part, which is activity and efficiency ratios. The efficiency or activity ratio measures a company's ability to manage and use its operational resources more efficiently. Furthermore, it is used to determine capacity and the extent to which a company's assets and liabilities can be used efficiently to create income. As a consequence, a shorter period suggests a higher efficiency ratio since it demonstrates that the company can manage its assets, liabilities, and outcomes effectively and efficiently. For inventory turnover, a company must have a specific quantity of inventory on hand to meet demand for its products or services. This is done to suit all business needs and keep clients loyal to the firm. However, it may vary every firm depending on profitability and operational efficiency. Dash lady uses a turnover ratio of 4.29 times in 2022 and 4.56 times in 2021 to generate sales from its inventory. It indicates that there is only a slight decrease. The average rate, which is not significantly different, demonstrates that the company's restocking is in line with its sales. Next, it can be observed that Dash lady has been effective in managing and selling its inventory. The next is average collection period. It is also known as an efficiency ratio, and it measures the average time it takes the firm to settle accounts receivable after credit sales. These receivables or account receivable often owe money to the firm, and the length of time it takes for them to pay back determines when the receivables can be turned into cash. In 2021, Dash lady spent 35 days collecting account receivables from debtors. It got less favorable in 2022 when it took 27 days to do so. It can have a negative impact on the company's finances. Therefore, companies need to reduce the average collection period. This gives the company ability to avoid increasing debt financing costs and maintain the ability to pay the current debt. For the total asset turnover, this measurement indicates that the value of the firm's sales to the total value of its assets. It is a measure of efficiency for a company in producing their income by using its property or assets. Dutch Lady has a total asset turnover of 1.59 times in 2022. It shows a reduction because in 2021 they recorded a total of 1.62 times for effectiveness in using all their assets. The reduction of the ratio after 1 year shows that the Dutch Lady is less efficient in generating income from its assets. The another part of activity and efficiency ratio is receivable turnover. This ratio can be used to assess an organization's efficiency in obtaining or collecting debt. It also depends on how well the company uses the credit it gives to the consumers and how the debt is collected by receivables management. In 2021, Dutch Lady's receivable ratio is 14.84 times. In 2022, they again see a drop with a ratio of 13.71 times as efficient in collecting receivables. It demonstrates that the company's collection policy is less systematic and disorganized. To maintain the company's financial stability, they should assess and enhance the credit evaluation procedure to ensure that transactions are only conducted with clients who have good and stable credit. The last part in the activity and efficiency ratio is fixed asset turnover. Generally, by doing the difference of net income with its fixed asset, it can calculate the operating efficiency ratio of a company. A higher ratio is better and beneficial because by using fixed asset, it implies productivity in producing good results. The fixed asset turnover ratio for Dutch Lady will be 5.17 times in 2021 and 3.72 times in 2022. As can be seen, the ratio is reduced by 1.45 times. It shows a very significant amount between the 2 years. In general, Dutch Lady has shown a slightly weak performance in terms of its efficiency and activity ratio. This is because on average the firm is less efficient in its overall management and operations when it experienced a decline from 2021 to 2022. If Dutch Lady Milk Industries Berhad can improve efficiency and ensure that the company's finance remains secure, it can help the company to attract more new investors. So that's all from me. I will pass to the next presenter.
Thank you to the previous presenter. Next, we move to profitability ratios. Profitability ratios was recognized as a tool that measure the firm's ability in using its assets and control its expenses to generate an acceptable rate of return. A higher ratio that the company obtains means that the company are performing well by making profits, revenues, and more. This also can be used to compare the finance with other company or the previous year of the company itself. So the first one, we have gross profit margin, which is the firm has 36.54% in 2022 compared to 2021, where Dutch Lady get 35.25% ability to control cost of goods sold to its revenue. The relative contribution margin from sales, it shows that the gross profit margin has decreased in 2022 than 2021 by approximately 8.7%. The suggestion that can be made for Dutch Lady Milk Industries Berhad to increase their gross profit margin is by reducing direct cost of goods. The direct cost of goods that will be calculated is including direct labor, direct materials, utilities, and more. The company may reduce the direct cost of goods by negotiate with the suppliers to give the company or firm a lower price for the materials. Second, we have operating profit margin. The productivity is 15.14% in 2022 compared negative 1.31% in 2021 of SIA return both creditors and stockholders. It shows that the operating profit margin has increased in 2022 compared to 2021. Based on the calculation, Dutch Lady OPM has increased, and it shows that they have highest efficiency in their management in order to operate their firm, and also it will a good perspective to both creditors and stakeholders. The suggestion that can be made by Dutch Lady Milk Industries Berhad to them for always maintain the margin and increase the assets in return both creditors and stockholders is by gross the net revenue, increase from productivity. Move to net profit margin. Dutch Lady Milk Industries Berhad has only 21.87% operating profit margin in 2021, and it decreased in 2022 where Dutch Lady has 3.45% in that year. The percentage of the net profit margin has been decreased from 2021, approximately about 18.42% of the profit after tax from the previous year. The suggestion that can be conducted by Dutch Lady Milk Industries Berhad is by boost their sales in order for them to increase the NPM in the next year. Return on asset. The firm has 5.47% in 2022 compared to 35.37% in 2021 of overall return of its asset investment. It shows that Dutch Lady Milk Industries Berhad has decreased their return on asset in 2022, reflects the decreased sales, higher cost and much less net income for that year. Increase their net income and improve the efficiency to use their asset is one of the suggestions for the company or firm to increase and maintain their return on asset. The company also need to always evaluate or analyze the operating costs that will be used by the company, the sales, including cost of sales and more. Last but not least, for profitability ratio is return on equity. The rate of return on the investment of the common stakeholders or net worth is 11.65% in 2022, while in 2021, the common stakeholders of net worth is 64.82%. Return on equity helps the company to measure a firm's efficiency at generating profits from shareholders' equity. Furthermore, the decrease in ROE shows that Dutch Lady Milk Industries Berhad effectively using the equity provided by shareholders. The suggestion that can be implemented by Dutch Lady Milk Industries Berhad to increase the return on equity is by reducing the inventory. We know that inventory is one of the assets in the company or firm, but by having too much inventory, it can turn out to be a liability. The company also need to use the money provided by the investor wisely and make sure that both selling and purchasing of the product are balanced or take place continuously. Next, we have market ratio. In this market ratio, we have earning per share. This market ratio, which is to measure company profitability on a per share basis, is calculated by dividing the company's net earnings by the number of outstanding shares. The EPS was 72 cents, and in 2021, it was 5.39 ringgit. This means for every RM1 of shares, the company generates 72 cents of income in 2022 and 5.39 ringgit in 2021. This EPS standardizes a company's profit by dividing it by the number of outstanding shares. This allows for comparing companies of different size within the same industry or even across industries. Dividend per share. It is a financial metric that represents the portion of a company's profit distributed to each outstanding share of common stock. For every RM1 of shares invested by the shareholders, they receive 50 cents of dividend. It is essentially meaning that the company paid out 60 cents in dividends for every RM1 invested by shareholders. Therefore, in both cases, the DPS is 50 cents. This means for every share of the company stock that a shareholder owns, they will receive 50 cents in dividends. A consistent or increasing DPS can be seen as a signal of the company confidence in its future performance and profitability. It implies the company has sustainable cash flow and sufficient earnings to share with the shareholders. Dividend payout ratio. It is a financial metric that expresses the proportion of a company earning paid out to shareholders in the form of dividends. The DPR for 2022 for Dutch Leading Milk Industries Berhad is 69.44% and for 2021 it is 9.28%. This means that in 2022 the company paid out a much larger percentage of its net income as dividends than it did in 2021. There are a few possibilities reasons for this change. One possibility is that the company's net income increased significantly in 2022 while its dividend payout remained the same. This would cause the DPR to rise. Another possibility is that the company decided to increase its dividend payout in 2022 even though its net income remained the same or even decreased. Next, we have price earnings ratio. It is a valuation metric that compares a company's current stock price to its per share earnings. Investors are willing to pay RM100.42 for every RM1 of the company's current earning. Similarly, for 2021, the PE ratio is RM71.89. This means that investors were willing to pay 71.89 for every RM1 of the company's earning in 2021. By having a high PE ratio can indicate that the stock is overvalued. This means that investors are expecting high future growth from the company or that they are willing to pay a premium for the company's current earnings. Last but not least, we have dividend yield. It is a financial ratio that represents the annual dividend income as a percentage of a company's current stock price. Dutch Lady distributes 35% of the market price to shareholders as dividend in 2022. Compared to 2021, the company distributes 6% of the market price to shareholders as dividends. The significant difference in company in dividend yields between 2022 and 2021 suggests that the company's dividend policy has changed. A higher dividend yield may indicate a relatively higher income stream from dividends compared to the stock's current price, but it is essential to consider other factors such as the company's financial condition and also the sustainability of the dividends when evaluating investment opportunities. To sum up, it is very crucial for Dutch Leading Milk Industries Berhad to make decisions about any of their firm's performance and the measurement tools because all the formulas and functions are applied to attain a specific requirement of the firm as the part of the firm's financial strategy. By analyzing their financial performance, Dutch Leading Milk Industries Berhad can identify areas where they are not as efficient or profitable as they could be. This could include things like reducing production costs, improving marketing campaigns, or expanding into new markets.